Good morning again. It is January 26th, Friday, 2023, and I've been asked many, many times to explain why Wyckoff works and why the principles work in that nature. And I was a Ford trader in 1981, and I was a runner at the Chicago Mercantile Exchange. And my name is Gary Fullett. And I watched the order flow of the orders coming from the trade desk into the pit. I was a runner, meaning I was a low paid clerk who ran orders to the brokers who executed the orders. There were large orders and small orders, and I think the large orders were certain prices. They must have meeting at certain prices. Some prices did not get traded often. They must not be that important. So I saw something called sales by price. How many contracts got traded each price, and I would bracket them. The highest price on the low end, highest price on the high end, and I would consider that my trading range because both volumes showed up at the end. Anyway, I thought that the price was important and the volume, amount of size of the volume, the amount of business came in. So a person said, why don't you try Richard D. Wyckoff method? I went to the library and took out a book. At least I tried to, but I was not a member of the exchange, so they wouldn't let me. So I copied the whole book of the library about the Wyckoff course. I read the course through. Very dry course, but the Bible of Wyckoff. And I took the quizzes and everything else. And I thought there was a big correlation between price and volume. So someone steered me towards the Wyckoff method. Price and volume are the only two indicators that we have that we can see in live time. Every other indicator you see, use, or are familiar with is a lagging indicator. Commitment of traders, moving averages, RSI. Something has to happen for those to work. Do they work? They do work. They work about half the time, or less than half the time. And probably less than probably 20%, because those are based upon breakouts, right? Moving average. If they follow the breakout, they follow it around. Most markets tend to stay in trading ranges. So the moving average turns up, it gets long. The moving average goes lower, it gets short, all within a trading range. So if you are going to look at a way to look at markets, why don't you look at things that are real time? Volume I can see come in every day. Now they calculate on a computer. And prices, I can see price. So why not follow the method or the way of current? I could trick a bank robber that robbed the bank yesterday, or one that's doing it right now. Rather do the one right now so I can try to catch him. So we're always comparing price relative to volume in the area the market trades in. So this particular price with that volume and that price is significant. So I'd want to mark that particular high. Right? Okay. All right. If now that is a market that is going up, but because the market sold off here, it actually was a selling net of a negative bar, but outside the scope of today's work. But high volume bars indicate buying, large range bars indicate buying. If the close up here, it'd be very bullish. In this case, the close was bad, it was bearish. So price and volume relative to the area that's trading in. That's how we look at price. So Richard D. Wyckoff was a trader back in the early 1900s. And he looked at all the great traders who traded. Keene, Rockefeller, Chase, places named after each other today. And he watched how they operated. And the operator was they bought value and they sold things that were that were expensive. We do that every day in our lives. We try to buy the cheapest price. Right? So he discovers price discovery. He finds out what is important, what area he begins to buy it. So in this case here, the market's going all the way down, and all of a sudden you see a buying bar. Come on. Market goes back down. Retest this. A retest of a market is a very critical aspect of Wyckoff. Outside the scope of today, a retest of support and close indicates buying and more buying. By the market going lower than higher, we call that the accumulation phase or a bullish phase. And the market goes up, forms a trading range, and continues to go up. So there are three principles of Wyckoff. 1, effort versus result. 2, cause and effect. 3, demand and supply. So let's do them in reverse order. A market that has large range and large volume would be considered a demand bar. If the volume and range is not that great, it's a buying bar. This is a demand bar, a special type of buying. This particular bar right here that we can see, it did not have a high volume. The range was fairly small, right? That's buying. The market's higher, but not demand. Same this way. This is a selling bar. We need both price and volume for a selling bar to the market. Okay. So, effort, demand and supply. We compare the demand to the supply and see who's winning that battle. 2, cause and effect. The more sideways the market goes, the more potential the market can go. If we go back and look at our trading range before, we can see a low here, a low like last time, a low. We want to mark that bottom, but I don't see a high. As the market goes sideways, we call that spacing or cost building. The cost building of the market. The larger the cause, the larger the effect of the market, either the upside or the downside. So market then, this trade range, this cause sideways here, can lead to a potential right here. Conversely, it can lead to the downside down here. We don't know which direction ever market goes to, but boom. Okay. So, cause and effect. The market is building cause to affect the market. And when the market's ready to go, hopefully, potentially, that's where the market becomes. When we get a market that has a range that's wider in high volume on the right-hand side of this trading range. So consider your left hand going to your mouse hand, to your right hand. When we get a special type of demand bar on the right-hand side, after testing and testing, we can call that potential sign of strength. SOS, sign of strength. It's how the signal, it's how the way the CM sees the other CM that markup is going to be. Eventually, not knowing when. Could happen immediately, could happen months down the road. But that's a signal to them, hey, that large bar on the right-hand side that shows price and volume, keep both eyes on. Conversely, if this was to the downside, this bar, we consider that a sign of weakness, like say on a ship, SOS, indicating that selling is overtaking demand and it's expensive enough to the bulls, so they wait for the Starbucks coffee to drop to $1. So that's what happens then. Okay. So we have now cause and effect, like gas in a car, more sideways, more potential. Demand supply is simply the bar range and the volume. A buying bar is one that just goes up. A demand bar goes up with larger length and very good volume. A little more, it's the same type of definition, but one is much. It's it's more difficult. It's the way to do it. Okay, now we have markets, and now we have the where we have effort versus result. If a market goes up that amount with that volume, everything else that is small in this range should have less range and less volume, right? If it's a smaller range, it's going to have, we assume, less volume, right? Because of the market. So if I just put a market like this to the downside, I may see the market's volume like this, indicating buying is more prevalent. When the market pulls back, selling is really holding on to their position. So I'm comparing price relative to volume to the area that it's in relative to each other. That takes a lot of work to go through. Again, I scope what's going on here, but Wyckoff works because Wyckoff is not a system. It's a way that a man like Richard Wyckoff looked at the markets through the eyes of the greatest traders in the world, called them composite operators, composite man. And he just tracked and just watched their movement. So there's no method. People say there's a method. The problem with Wyckoff, it takes work and time to do so. People want the 2-day moving average, say, well, I'm going to buy a 2-day moving average and walk away. Wyckoff is not that. Wyckoff requires you to work. It requires you to have a situation to where this is understanding where the market is in the market cycle. On the right-hand side, the market's ready to move up. Here, way too early in the trading range to give me a large move until it went more sideways. Again, you put gas in the car, it can go, but does not matter, right? Cause and effect does not matter. And the larger the cause, the larger the effect of the market. There's no really effect, there's no really cause here. Can't go up much here. Fills out more, gives you a potential move. Very important, all important principles. They cannot be denied. They're principles. Effort result is the most difficult one to explain, but one of my favorites. And again, we compare price and volume. If price is 1 inch long on 1 million shares, if it has if it has 500,000 shares, it should go up a half an inch. Sorry for our metric people. Say 1 meter, 2 meters, right? Okay. If the market has 1 million shares, we expect that to move twice as far as one that's got 500,000 shares. If the 500,000 share bar is similar than the 1 million bar, then we have to see that the market here is seeing something, right? Maybe the selling into the rally is not as prevalent because of less volume. So we're always judging the market's action to each other, just simply watching, hey, it went up $4 in a day, then the next day it went up $2 in a day, slowing down. The market volume was different, higher and lower. So all legitimate reasons why that occurs, move-wise, because you have all these different cause we have cause and effect from. Okay. Larger the cause, larger the effect. Demand is special buying, supply is special selling. Cause and effect, comparing the market's range relative to the volume to each other, and where in the Wyckoff cycle paradigm that occurs. On the left-hand side of the market, where it means very little, go sideways. On the right-hand side of the market, more effective because the market can leave the trading range on the right side of the market. So Wyckoff is the only method that utilizes the live data that happens. Everything else has to happen down the road. I would rather watch live data, even though you have live machines, to see what the price of the volume is at the current time versus waiting. The best way to do it. There's no gimmicks or tricks. It's very difficult to trade. And there's a million methods out there to make money. There's probably 2 million how to lose money. So you want to make sure that you're doing the very best trade which you can, and be at a point to where that you just understand this. You have to stick with you your whole life. If you follow Wyckoff, believe me, it's worth it. But you don't bring it up in chart wise. You just assume it by writing your lines down that way. So a very important aspect of Wyckoff. The 3 principles, they can't be denied, and they must be studied, and that's the key to success in Wyckoff. Thank you for your time tonight. I hope that was helpful. There will be more videos down the road, and have a great day. Thank you.